Hi everybody, welcome to another update on the Gold Forecaster Index, the holy grail to predicting gold prices. In my last video, I said that we should buy gold because it's the anti-bond. So let's look at the performance from last month. Gold has actually risen, very good, and bonds, which is TLT, have crashed. So that was a very good call. And now we are going to look at a new data point. Let's see what the gold forecaster index is going to forecast this time. This is based on leading indicators. So normally, if it goes down, then gold should be going down a few months later. So the latest data point says that gold will be weak. So keep that in mind. We are not there yet. There will be some weakness in gold because the gold forecast index is still negative. So I want to be positive, but data shows that there can be weakness. Taylor roll rate is still above 0, which is good, but it's starting to come in the negative territory, and that's also very bad for gold. As you can see here, whenever this is in a negative territory here, then gold will underperform. Whenever it's in positive territory, then gold will go up. Here it will go down. Here, that's all positive territory. So this is something that I don't like to see. So be wary about that. It could be that we go into deflation and at some point we need to buy bonds. Misery index, the same, is going down. So I want to see unemployment go up and inflation go up. And that's not what we're seeing right now, which is also bearish for gold. Real output, the same, is improving. So it has actually gone in the positive, this green line, which is minus the productivity. So it's also improving. That's also bearish for gold. So yeah, it's not looking that good. GLD, same. The ETFs are selling their gold holdings. That's also bearish for gold. But there is this gap. We will talk about that later on. This is the central bank buying gap. But okay, if you look at the orange line, it's going down. That's not good for gold. Here it's a bit flat, also trending down. So ETFs are selling. LBMA also down, which is also bearish gold. I don't have a lot of positive things to say about gold right now. China gold demand is also topping out, so this trend is dropping. Also bearish gold. Silver demand, there's no silver squeeze at all. SLV holdings are down. PSLV holdings are flat. So for silver, it's also not that good. China demand dipped and rebounded a bit, but probably going down again. COMEX numbers trying to bottom out. We'll see. Central banks have been buying gold. China has been buying gold, so that's good. Here you can see China buying. These people also buying Poland, but we have seen huge selling from Turkey and Uzbekistan and Kazakhstan. We'll see how this evolves. US mint sales are not that great, down. Premiums are down. So premiums down. Junk silver premiums down a lot. So silver is not looking good if you look at the APMEX junk silver premiums. Luckily, we do have positive premiums for China gold. So we are currently at 2% premiums for Shanghai gold. So that means we probably have a bottom in gold, but yeah, there are also negative signs. This one is one positive sign. Yeah, Shanghai gold premiums are positive. PSLV premiums are still negative. COT report is slowly moving higher, so there could be still downside in gold here as well. And this could keep on rising and gold would fall back to 1850 probably. Same here with silver. So the COT report is not looking that great. Open interest is also low, so not a lot of people interested in gold. So this needs to move higher before the bull trend in gold can resume. Lease rates not good either. As you can see here, lease rates down, which means this is a top. So it's really not good, looking good for silver as well. Lease rates down, silver will go down. Luckily, the Swiss franc is strong. That's good. Tips still very negative for gold. Real yields have gone positive, so that's also a bad sign for gold. A lot of bad signs, but seasonality is good. So in August, typically gold goes up. So there are some positive signs, at least. Silver, yeah, will be flat to down. Silver seasonality is bad in August. Yeah, not a lot of good things to tell in this video. Gold miners sentiment is bad, so maybe it can turn back up. But sentiment is not good at the moment. 30-year versus 10-year ratio. Yeah, this seems a bottom, so maybe this can go up and then gold can rise. Google Trends tells us that sentiment is still dropping, so not good for gold. Yeah, debt to GDP should rise. That's positive. Near-term forward spreads are still in the negative, so that should be positive for gold. Rates hikes. Let's see. Yeah, I think rate hikes should start topping out. I think the Fed will start pausing. That's what I think, because this 2-year yield starts to top out. So I don't think the Fed can keep hiking rates any longer. And that is positive for gold. So let's see what Powell will do. This is also positive. We have seen increasing foreign gold deposits at New York this year. So that means that central banks are buying gold. So at least we have the central banks backing us. Bank term funding program still rising. That means banks are in trouble still, regional banks. This is still old data. We will see what happens there. Let's take a look at the stock forecaster, because I think the stock market is trying to make a top. Okay, so this is the stock forecast index is still in the positive. Yeah, stock market is pretty strong. Also, the Brave Better Skelly index is still in the positive. That's the red line. So yeah, stocks are pretty strong, but the PE ratio is very high. Buffett rule is very high, 150%. So stocks are overvalued to me. So I would not get into that sector yet. I want to see a crash. Leading indicators are very low, but they are trying to make a bottom. Stock valuation, yeah, stocks are still cheaper than bonds. So I would not buy bonds either. Yeah, daily forecasts still says that stocks are going to move up, as you can see here. But yeah, we are currently above the average line here for this year. So this could drop a bit maybe and then go back up for next year. So take this into account. We are pretty fair value right now for stocks. Um, Capex is still very low, so I don't think that stocks can rise that much. And this is the chart that I wanted to show. The smart money is actually leaving the stock market, while the dumb money is still buying. So this is a red flag for me. I would avoid stocks right now. Same here, the smart money still has some downsides, 3%, and for next month it's 1% down. So yep, avoid stocks. The returns are very bad, as you can see here. What is the 10-year return? It's maybe 2% return. So it's not a good time to buy stocks. Same here, maybe a 2% return if you buy stocks. You can see that here, this chart is the same as this. Not a good time. Part-time workers are coming down. So that's a bad sign for stocks. Every time that this goes down, then we have a recession. But we do have some good news. Truck sales are at an all-time high. That's the green line here. See, the truck sales are at an all-time high. But typically when that happens, for example here, then and it drops again, then we have a recession. So these peaks here typically tell us that there will be a recession coming, because everyone has bought trucks now, they don't need trucks anymore, and then sales will go down. And the recession comes maybe next year. It could take a while. As you can see here, truck sales down, and then we have a recession and stocks will drop. Profits are still going to be okay, and because the orange line is in a plus, but this is Q1. Let's see what Q2 gives. Liquidity is going to drop off. That's the red line. So I expect stocks to be poor in performance. We also know that the Fed is now moving from issuing bills into issuing treasuries. That's important because if they issue bills, they can draw down the repo facility, and now they can't do that anymore. They are going to issue treasuries instead, and that will drain liquidity from the market. So expect this to go down, treasuries to go up in yields, and then stocks will crash. That's what I think will happen. But here, this looks not bad. Good spending is still in the plus. I had hoped that good spending would drop, but there are some signs that the economy is still strong. Banking conditions are getting worse, so they are tightening. That's typically not good for stocks because a recession will come. Manufacturing new orders. Let's see. Yeah, it's still very low, but appears to have bottomed out, but it's still low. Building permits slacking around here. Rate hikes, I think that they will start pausing rate hikes, and that means that stocks will fall. Every time when they stop the rate hikes, then stocks will be weak. We are still in an inverted yield curve, which is bad for stocks. Home builders have been strong, but at some point they will roll over and the VIX could spike. So avoid stocks. Gold, yeah, could have some weakness, but I would still stay in gold. Let's take a look at the budget deficits have been soaring again. Services have gone down a bit. Goods deficit is still flat. Looking at this chart, I think that the trade deficit will increase. So the chart is going down, which means that trade deficits should increase in the future. That's bad for the dollar. Import prices up, export prices down. So that's going to add to the deficits. Imports, exports, let's see. Oh, this is Q2. So both are dropping. That means that GDP will drop. So also bad data here for stocks. If both of these go down, that means that stocks will go down as GDP drops. So a lot of evidence that we should avoid stocks. Central banks are still tightening. At some point, they will need to reverse if the stock market crashes. Deposits, let's see. Deposits have been stable, but they could drop if the banking conditions worsen. I could see this drop. Loans have been flat. It went up a bit last week, but keep looking at this. If it starts dropping, then stocks will start dropping as well. Capacity utilization is dropping to 78.8. That's going to give disinflation. Yeah, but it's still very high, around 80. But yeah, this tells me that there is disinflation, which is not good for gold. This we already talked about. The Fed will pause rate hikes. And here you can see the trajectory. They are probably going to cut rates from next year onwards. And that should boost the gold price. As the Fed cuts rates, gold will rise. Okay, on to some blog posts. China has been buying the dip in gold, as you can see here. Yeah, they bought 25 tons, then it went down a bit in April, and now they are ramping up the purchases again, up to 25 tons per month. And you can see here the purchases. Every time when China purchases gold, you can see that gold rises. Same here, gold rises. They bought here, and then it also went up. Here they bought and it went up. So they always buy the dip. They will never buy at the top here, flat. Here it was a top. They didn't buy. So now they are starting to buy again. So that means that this should be a bottom and we will go higher. Just follow what the Chinese central bank does. Bond yields are soaring. Not today, but in the past month, they have gone above 4%, a high of 4.2% even. Now, who is going to buy those bonds? I don't think that any of these actually want them. Japan needs to defend its yen. The Chinese are selling. You can see that they are selling. UK has problem with inflation, so they can't buy. Belgium has problem with the budget. Switzerland has problems with their stock portfolio. So not a lot of candidates to buy those treasuries in the coming months as they start issuing those treasuries. We know that they need to issue $1 trillion in treasuries. So who is going to buy this? I actually think that treasury yields could rise some more. And as you look at this correlation, every time that yields go up, gold goes up. So yields up, gold up, and it's positive correlated. Even here, it's positive because here the yields went down and gold also went down. And then this is positive correlated, positive, and only here something changes. Why did this change? Yields down, but gold up. Well, you can easily see from here on out, central banks are net buyers again. So here they started to buy gold. That's why gold went up, even when yields went down. So now central banks keep buying gold. So this is a positive momentum for gold, and bond yields are rising as well. So as bond yields rise, gold will rise as well, because bonds tell us that there is inflation. And I think that we are still in an inflationary period, even though there are some disinflationary signs. But I think inflation will prevail. And that's why you need to be in gold. And the central banks know that. Mark Farber thinks that we will reach 15% in bond yields. So that's about here, the top of 1980. So we are going to reach 15% in the coming years. So better prepare for a rise in gold when that happens. Now, I wanted to say something about this gap here. Why is there a gap here between the gold price and the GLD assets? Well, that's easy because gold is being bought by central banks lately at the end of 2022. So at the end of 2022 here, central banks started to buy gold. So that's why this went up, even though the GLD holdings went down. So we need to thank the central banks for buying gold. Otherwise, gold would have gone down. Something about oil again. I'm not in the oil sector right now. I'm actually waiting for a recession to happen, and then oil will be weak. Also, I still see these rig counts go down. We still have positive oil production year over year. So I want to see this go to zero first. When it goes to zero, then I think the bottom is in. Every time when this goes to zero here, then we have a bottom in oil. So I want to wait for that bottom. So each month I will check what the production is year over year. As long as it's above zero, I'm not going to buy any oil stocks. Okay, so that's for oil. And here's another reason why I don't like oil. Why should I buy oil when I can buy copper, for example? So what is the oil demand forecast for the coming years? It's going to increase by maybe 5% over a very long time, 10 to 20 years. What is 5%? It's nothing. 5% is nothing. While production is going to rise a lot. You have all of these offshore oil plays, like Guyana is going to add a lot of oil. Venezuela is coming online, going to export to USA as well. Many of these Middle East countries are going to increase oil. There's plenty of oil, while there is not a lot of demand. So why should I buy this? Copper is much better because you can see here in the coming years, it will double in demand, 25 to 50. You can see that here. So this is oil demand going up maybe 5%. Copper demand is going up much faster. So this is the growth rate. You can see that copper's growth rate is much higher, 20%, 30%, compared to only 5% for oil, right? And this is the 5-year growth. So per 5 year, the growth is going to go down for oil. Copper is going to peak in demand growth. So I would just buy copper instead of oil at this point. Small intermezzo. Overall, what are we going to do with gold? Not sure. We have positive signs and we have negative signs, but I still feel safer to be in gold than in stocks at this moment. And bonds, not sure about that. I know that the Fed is going to issue a lot of treasuries in the coming months, so I think bond yields will keep on rising. Yeah, that's what I think, and so we should not be in bonds. So let's take a quick look at the bond forecaster index. Here we see that it's rising, so that means bond yields will go up. Here it went down, so bond yields went down a bit, but now it's rising again. So the blue line is rising. That's bad for bonds. Bond yields will go up. Okay, so lately the blue line has weakened a bit, so keep watching this chart. But I'm not that interested in bonds right now. Because the foreigners are not buying them. China is not buying, Japan is not buying. Nobody likes treasuries. Also here, the bond valuation model. If you look at this, you can easily see that bonds are still overvalued. So this is a stock to bond ratio. Stocks are undervalued compared to bonds. So this could still rise a bit. 4, 5%, 6% bond yields, and then I would buy. So it's not the time yet to get into treasuries. Here is the stocks to bond valuation model for corporate bonds. And here it's at the 0 line. So compared to corporate bonds, those bonds are actually fair value. Maybe here you can start nibbling, but treasuries I would avoid. This is the treasury because they are still overvalued. So what does that leave us with? We have stocks to avoid, bonds to avoid. So either you buy gold or cash. Those are the two options. And I choose gold still. Okay, that was the update, and I'll see you in the next video.